Imagine trying to design a structural blueprint with your left hand while writing lines of mobile application code with your right. For technical founders building digital tools alongside their existing service businesses, that cognitive split is a daily reality. The operational challenge is scaling a new, mass-market digital product while continuing to deliver the high-touch B2B engineering services that keep the business solvent. The instinct for most founders facing this split is to immediately wall off the new venture. They assume they must file paperwork for a new LLC, secure a separate tax ID, and open a dedicated bank account before launching the software. But mimicking a multinational corporate structure at the sole proprietor level creates an unforced error. It fractures your focus and generates a baseline of administrative drag that can consume the time needed to actually build the product. Absolute financial and logical separation between business lines does not actually require legal separation. There is an alternative architecture, one legal entity operating through two internal divisions, supported by a single, unified back office. This 1x2x1 framework is designed to minimize administrative friction while maintaining the granular data tracking required to monitor the health of each venture. To see this in practice, we look at MotaQm, a sole proprietorship run by Yuki Hayashi out of an office in Tokyo's Yaesu district. Hayashi manages both a technical CAD engineering firm and a software development operation under a single trade name and a single legal identity. The MotaQm model treats structural efficiency as a mathematical optimization of the founder's limited resources, rather than a legal requirement. The foundation of the MotaQm blueprint starts with identifying the absolute legal minimum required to operate. This organizational chart shows that at the highest levels, the legal entity and business core, the structure rests on a single individual. Hayashi maintains a single base of operations in Yaesu and uses one unified invoice number for every transaction, regardless of the service provided. This is the rule of legal unity. The founder uses only one trade name, MotaQm, and files one consolidated tax return for all commercial activities. To maintain this simplicity, the foundation requires a single primary bank account for both distinct businesses. Splitting bank accounts or duplicating software based on product lines creates exponential accounting labor. You end up doubling reconciliation time without generating additional revenue. This consolidation is supported by the National Tax Agency, which guides founders to report multiple diverse income streams on a single return. However, this creates a data problem. If engineering profits and app development expenses flow into the same checking account, it becomes difficult to see which side of the business is actually performing. By enforcing a single entity foundation, a founder eliminates half of their administrative baseline, but they must solve the tracking problem through logic rather than legal filing. That tracking problem is solved through virtual departmentalization. On the third layer, the MotaQm core splits into two operational arms, the blue engineering division and green apps division. Notice the accounting tags at the bottom. Instead of separate bank accounts, separation is achieved through ledger tags within the accounting software.
This allows the founder to assign every transaction to a specific division as it hits the single bank account. The ENG tag is assigned to CAD software subscriptions, drafting labor, and revenue from engineering services. The APP tag isolates costs like server hosting, developer tools, and Google Play registration fees. This discipline yields granular profit and loss statements for each division. The founder knows precisely how much is being invested into the app versus how much is being earned by the engineering services. While titles like MotaQm Engineering or MotaQm Apps are used for branding and marketing, they remain strictly internal and carry no legal weight. Virtual separation provides the data clarity of a conglomerate, but without the friction of siloed corporate infrastructure. Beyond direct expenses, both divisions rely on a shared operational baseline, the rent, software, and platforms required to exist.
In the fourth layer of the chart, the two departments filter down into a single shared back office. This unified office then connects to the external interfaces that interact with the outside world. A third accounting tag, Common, is used to track shared overhead like the Yaesu office rent and the accounting software subscriptions. This shared infrastructure allows the existing business to subsidize the new digital venture. For example, instead of building a new website for the apps, the founder can use subdirectories on the primary domain, like MotaQm.jp/apps, to share existing SEO authority. This also solves the compliance hurdle for software deployment. Google Play requires a verified DUNS number and a physical business address for organizational accounts. By leveraging MotaQm's existing trade name and the Yesu office address, the founder bypasses these verification steps instantly, saving weeks of administrative setup. The only point where the two businesses must diverge is in legal documentation. While engineering requires NDAs and invoices, the app division requires public terms of service and privacy policies. This unified backend effectively transfers the established credibility and physical assets of the primary business directly to the new venture. This architecture allows a single individual to manage a sophisticated multi-product operation while remaining agile. Looking at the MotaQm blueprint in its entirety, everything routes systematically from the owner, through the departments, into a single foundation. The banner at the very bottom of the chart makes the central principle explicit: do not incorporate until necessary. At a certain point, however, market forces will dictate that this optimized sole proprietorship must transition. Definitive triggers for this change include stable app revenue, hiring employees, demanding enterprise contracts, or preparing for a sale. When hit, transition by replacing the top sole proprietor node with an LLC. The internal divisions and back office beneath remain exactly the same. Even at this stage, creating multiple separate companies is rarely the optimal move. The core logic of the architecture scales into the corporate phase. Organizational complexity should only be introduced when external forces demand it. Until that moment, structural simplicity remains a solo founder's greatest competitive advantage.